Thank you for watching Finance and Wealth Matrix channel. I am financial strategist working in wealth management for more 20 years. All my videos on this channel is about finance and how can maximize your saving in this era. Welcome to part 2 of How Millionaires Invest 7 Rules. Before we dive into today's topic, I'll recap the key lessons from the previous video in every part. If you haven't watched part 1, Invest Like the Wealthy from Scratch, I highly recommend checking it out first as it lays the groundwork for everything we'll cover in this video. You've probably been told the secret to wealth is finding the right stock, getting into crypto at the right time, or knowing someone on the inside. That's a lie, and it's an expensive one. Here's what actually separates people who build real wealth from people who stay stuck. It's not what they invest in. It's how they think about money, time, and discipline. And today I'm going to show you the exact system wealthy people use, including the specific accounts and investment types that make it work. Not theory, not motivation. The actual mechanics. I've spent over 20 years in wealth management, and I've sat across from people worth tens of millions of dollars. None of them got there by luck. None of them had a secret. But every single one of them followed a pattern so consistent it almost felt like a formula. So that's exactly what I'm going to give you today. The formula, broken into real steps you can start this week with the exact accounts and investments to match. Here's where we're going. We're going to talk about the single biggest thing destroying your ability to build wealth right now. Then, we're going to cover how to actually structure your money across the right accounts in the right order. And I'm going to show you the specific investments that wealthy people use at each stage. Not just categories, but actual names and types you can look up today. Let's start with the thing nobody wants to hear. Bad debt is not just a problem. It is a wealth-destroying machine running in reverse, 24 hours a day, 7 days a week, whether you're sleeping or working or doing anything else. Every dollar sitting on a credit card at 18% interest is compounding against you, not for you, against you. That's not investing. That's paying someone else to get rich while you stay broke. Here's the mindset shift that changes everything. Paying off an 18% credit card is a guaranteed 18% return on your money. No stock, no fund, no investment on earth gives you a guaranteed return like that. So before you open a brokerage account, before you pick a single fund, you need to look at every debt you carry and ask, is this bad debt or good debt? Bad debt is credit cards, personal loans, car payments on a vehicle that's losing value every month. Good debt, in the right context, is a mortgage on property that appreciates, or a business loan that generates income greater than the interest cost. The difference is whether the debt is working for you or against you. Here's how to attack it. List every debt you have. Write down the balance, the interest rate, and the minimum payment. Then pick one of two strategies. The avalanche method. Attack the highest interest rate first, pay minimums on everything else. Throw every extra dollar at the most expensive debt. This saves the most money mathematically. Or the snowball method. Attack the smallest balance first, get a quick win, build momentum. This works better psychologically for a lot of people. Either one works, the one you actually stick to is the right one, and here's why this matters beyond just paying off debt. Every $300 a month you free up from debt payments is $300 a month you can redirect into investments. Run that $300 a month at a 10% average annual return over 30 years, and you're looking at over $600,000. That's not the debt payoff. That's what comes after. That's the real prize. But here's where most people stop. They pay off the debt, breathe a sigh of relief, and then slowly let lifestyle fill that gap back up. Don't do that. The moment a debt payment disappears, automate that exact dollar amount into an investment account before you ever feel the difference in your checking account. We'll talk about exactly which account in just a second. Now, let's talk about the account structure that wealthy people actually use, because this is where most videos skip the details and leave you guessing. The wealthy don't just invest, they invest in the right containers, in the right order to minimize taxes and maximize growth. Think of it like this. It's not just about what seeds you plant. It's about which soil you plant them in. The first container is your employer's 401k or 403b if you work in education or nonprofit. This is the starting point for almost everyone with a job. And the reason is simple. If your employer offers any kind of match, that match is an instant 50% to 100% return on your money before the market does anything. If your employer matches 50% up to 6% of your salary and you're not contributing at least 6%, you are leaving free money on the table every single paycheck. That's not a figure of speech. That's literally money being offered to you that you are declining. Inside your 401k, you're going to see a menu of fund options. Here's how to think about them. Look for low-cost index funds, specifically ones that track the S&P 500, total U.S. market, or total international market. The expense ratio on these should be under 0.20%. Many are as low as 0.03%. That number matters because fees compound just like returns do, but in the wrong direction. If you're under 40, lean toward a higher stock allocation, 80 to 90% in diversified stock index funds. If you're over 50, start shifting some toward bonds for stability. If you don't want to think about this at all, target date funds do this automatically. Pick the one closest to the year you plan to retire. Simple, effective, underrated, contribute enough to get the full employer match. That's your 401k floor. Now, here's where it gets interesting, and this is the part most people don't know. After you get the full employer match, the next best account is often not your 401k, it's a Roth IRA. Here's why. A Roth IRA grows completely tax-free. You put in after-tax dollars, the money grows for decades, and when you pull it out in retirement, you pay zero taxes. Not lower taxes. Zero. For someone in their 20s or 30s, that tax-free compounding over 30 or 40 years is one of the most powerful wealth-building tools available to ordinary people. The 2024 contribution limit for a Roth IRA is $7,000 per year, or $583 a month. You can open one at Fidelity, Vanguard, or Schwab in about 15 minutes online. No employer required, no middleman. Just you and a tax-advantaged account working for your future. Inside your Roth IRA, the investment world is your oyster. You're not limited to your employer's fund menu. You can invest in broad market index funds like the Vanguard Total Stock Market Index Fund, ticker VTI, or the Fidelity Zero Total Market Index Fund, which has a zero expense ratio. Zero. You can add international exposure through something like VXUS, which covers international stocks outside the U.S. You can add a small allocation to a real estate investment trust index fund for property exposure without buying property. The combination of a 401k up to the match, then maxing a Roth IRA, then going back to the 401k if you have more to invest, that's the sequence. That's the order. And it's not complicated once you see it laid out. That's important, but if you don't also understand how to invest inside these accounts, the accounts alone won't save you. Let me break down the actual investment strategy that goes inside these containers, because this is where people get lost. Wealthy investors don't pick individual stocks. I know that's not what YouTube wants you to believe. Individual stock picking is exciting. It makes for great content. But study after study, and I mean decades of academic research, shows that over a 15-year period, more than 90% of actively managed funds fail to beat a simple index fund. Professional fund managers with research teams and Bloomberg terminals can't beat the index consistently. What makes you think you can? Index funds are the answer. They're boring. They're simple. And they work. Here's the core portfolio that covers most people in most situations. A broad U.S. stock market index fund for your domestic exposure. A total international stock market index fund for global diversification. A real estate index fund, or REIT fund, for property exposure without a down payment. And as you get older, a bond index fund to add stability and reduce volatility. That's 4 funds. That's it. You can build a portfolio worth millions with those 4 funds, rebalanced once a year, with contributions automated every month. Now let me talk about something that almost nobody discusses in these videos: health savings accounts, or HSAs. If you have access to a high-deductible health plan through your employer, an HSA is arguably the most powerful investment account that exists. Here's why. Contributions go in pre-tax, the money grows tax-free, and withdrawals for qualified medical expenses are tax-free. That's triple tax-free. No other account does that. And here's the move wealthy people make with HSAs. They pay current medical expenses out of pocket, let the HSA grow invested in index funds, and then in retirement they use those funds for medical costs, which are often the largest expense in retirement, completely tax-free. Or, after age 65, they can withdraw for any reason, and it acts just like a traditional IRA. If you're eligible for an HSA and you're not using it as an investment account, you're missing one of the best tools available to you. That's important, but there's another layer to this that separates people who build wealth from people who just save money. Let's talk about the actual behavior of wealthy investors, because the accounts and the funds are only part of the equation. The other part is what you do, and what you don't do, when things get uncomfortable. The single most destructive financial behavior is not overspending. It's not even debt. It's reacting emotionally to market drops. Here's what happens. The market falls 20%. The news says it's a crisis. Your portfolio is down. Your gut says, sell everything and go to cash. And that feeling is almost impossible to resist in the moment. But here's what actually happens when you do that. You lock in your losses, you miss the recovery, and you're left trying to figure out the right time to get back in, which nobody can do reliably. Missing just the 10 best trading days in the market over a 30-year period cuts your total returns nearly in half. 10 days out of more than 7,500. And those 10 days almost always happen right in the middle of the scariest moments, right when your instinct is screaming at you to be out of the market. The wealthy investor's response to a market drop is not panic. It's the opposite. It's excitement. Because they know that every dollar they invest while prices are down buys more shares, which means more compounding when prices recover. They've trained themselves to see a market correction the way a shopper sees a sale. Everything you wanted is now cheaper. That's a good thing. This is why automation is not just convenient, it's essential. When you set up automatic monthly contributions to your 401k and Roth IRA, you remove the decision entirely. You buy when prices are high, you buy when prices are low. Over time, your average cost per share smooths out, and you capture the full long-term return of the market without the emotional damage of trying to time it. Dollar cost averaging is the technical term, but the practical term is just keep buying, no matter what. Now let's talk about a concept that the wealthy understand deeply, and most ordinary people never grasp. The difference between assets and expenses disguised as assets. A car is not an asset. It's a depreciating liability. The moment you drive it off the lot, it starts losing value. A new car loses roughly 20% of its value in the first year. Financing a $50,000 car at 7% interest means you're paying $3,500 a year in interest on something that's losing value simultaneously. That's a double loss. The wealthy drive reasonable vehicles. Not because they can't afford luxury, because they understand the math. A primary residence is more complicated. It can build equity over time, but it also comes with property taxes, maintenance, insurance, and opportunity cost on your down payment. It's not the automatic wealth builder people believe it is. Real estate as an investment vehicle, rental properties, REITs, real estate index funds, is a different conversation entirely. The assets that build wealth are things that put money in your pocket without requiring you to trade time for it. Dividend-paying stocks. Index funds growing in value. Rental properties generating cash flow. A business that runs without you. These are assets. The rest is just stuff. Here's the practical filter to run every major purchase through. Before you spend, ask, is this moving money away from assets or toward them? Not every purchase has to go toward assets. That would be an exhausting way to live. But you need to be honest with yourself about the ratio. Wealthy people spend money on things that matter to them personally. They just don't spend it trying to impress people who aren't paying attention. And that brings us to the concept that ties everything together, the gap. Wealth is built in the gap between what you earn and what you spend. That's it. That's the whole game. The wider that gap and the longer you invest it, the wealthier you become. Income matters, but it's not the whole story. There are people earning $200,000 a year with no net worth because the gap is zero, And there are people earning $60,000 a year quietly building million-dollar portfolios because they've protected that gap aggressively. Every time your income goes up, raise, bonus, side income, the instinct is to upgrade your lifestyle proportionally. Fight that instinct. Take 70% of every income increase and route it directly into investments before it hits your lifestyle. You'll still feel the raise, but most of the new money goes to work before you ever get attached to spending it. Lifestyle inflation is silent, it's comfortable, and it will steal your future one subscription, one upgrade, and one impulse purchase at a time if you let it. If you've gotten value from this breakdown so far, and I mean real, actionable value, not just motivation, drop a comment below with which account you're going to open or optimize this week. I read every comment, and it helps me understand what to cover next. And if you know someone who needs to hear this, share this video with them. Most people never get this laid out in one place. Now let me give you the complete picture in one clean summary, because this is the part you want to write down. Step 1. Eliminate bad debt aggressively, starting with the highest interest rate. Every dollar freed from debt becomes an investment dollar. Step 2. Open and fund a 401k up to the full employer match. That's your guaranteed instant return before the market does anything. Step 3. Open a Roth IRA at Fidelity, Vanguard, or Schwab. Max it if you can. Invest inside it using broad market index funds. Step 4. If you're eligible, treat your HSA as a triple tax-advantaged investment account, not just a medical expense fund. Step 5. Invest consistently every single month through automation. Never let emotion make the decision. Step 6. Build a simple diversified portfolio of index funds across U.S. stocks, international stocks, real estate, and bonds based on your age. Step 7. Protect the gap between income and spending every time your income grows. That's the system. It's not complicated, but it requires you to choose boring over exciting, consistent over clever, and patient over reactive. Every single time. The people sitting on multi-million-dollar portfolios didn't do anything extraordinary. They did ordinary things, the right ordinary things, for an extraordinary length of time. That's the real secret. And now you have it. Your move this week is simple. Pick one step from this list and do it, not all 7. 1. Open the Roth IRA. Increase your 401k contribution by 1%. Pay an extra $200 toward your highest interest debt. One move. This week. Because the best time to start was 10 years ago, and the second best time is right now.
Subscribe if you want the next level of this. I'm going deep on how to actually pick the specific funds inside each of these accounts, what to look for in a target date fund, and how to build the exact portfolio allocation based on your age and timeline. That video is coming, and you don't want to miss it. I'll see you there.